Hi, I'm Amy Ford, and I'm going to teach you all the basics for accounting for long-term liabilities. One topic, accounting for bonds payable, can be particularly difficult for the introductory accounting student. We'll go through each topic together, and I'll walk you through all the basics. Liabilities are the obligations or amounts owed by a company. Liabilities are classified as either current or long-term. Current liabilities are the obligations that are expected to be settled or liquidated in the ordinary course of business during the next year or the next operating cycle, whichever is longer. So a good rule of thumb is just to remember in the accounting world, current means within 1 year. Any obligation you must settle within 1 year is a current liability. Examples are accounts payable and accrued expenses, such as accrued wages. Now, a short-term note, such as a 6-month loan from the bank, is a current liability. Long-term liabilities, which are sometimes referred to as non-current liabilities, are obligations that are due in more than 1 year. If a liability doesn't meet the classification as a current liability, then it is a long-term liability. Bonds and installment notes are the two main types of long-term liabilities covered in introductory financial accounting courses, and those are the two main topics of this video. Let's start off with a question. Why do companies use bonds? Bonds are another form of borrowing, similar to a note or a loan. But instead of financing with one bank or one lender, you are borrowing smaller amounts from many individual bond holders. Bonds have maturity dates and interest rates like loans. Some of the key items found on the bond certificate are important for understanding the accounting for the bonds. The face amount is the amount listed on the face of the bond certificate. This face amount is the principal that is required to be paid back at maturity. The maturity date is also found on the bond certificate. The stated interest rate is the rate found on the certificate and is the rate used to calculate the interest payments to the bondholders. The interest payment dates for the bond are another important factor you need to know. Most bonds pay interest semi-annually, such as every January 1st and July 1st. When you issue the bond, the amount of cash proceeds the borrower receives is called the issue price. One very confusing concept that you have to understand the basics for bonds is that the issue price is not necessarily the face amount. The price the bonds are issued at depends on the relationship between the stated interest rate and the market interest rate. Remember, the stated interest rate is the rate found on the bond certificate. Now, if the two rates are the same, then we say the bond is issued at face value. If the borrower is issuing $1 million of bonds, then the proceeds, the amount the borrower receives on the issuance, are $1 million. If the stated rate of interest is more than the market rate of interest, we say the bond is issued at a premium. If the borrower is issuing $1 million of bonds, then the proceeds are more than $1 million. Now, so for example, the issue price could be $1,100,000. But just remember, no matter what the issue price, the face value, $1 million, is the amount the borrower has to repay at the maturity date. If the stated rate of interest is less than the market rate of interest, we say the bond is issued at a discount. If the borrower is issuing $1 million of bonds, then the proceeds are less than $1 million. Let's say, for example, the issue price is $950,000. On the issue date, the borrower receives $950,000. But on the maturity date, the borrower will have to repay the $1 million. Now let's go through an example together to practice this concept. Now, one trick I've learned in teaching this bond concept to students over the years is to imagine a carnival or a market where vendors are selling their wares. So imagine we have a booth at this carnival and we're issuing our bond to the crowds that are walking by. A share of our bond has a face value of $1,000, and our bond has a stated rate of 6%. So what are we doing? We're yelling or promoting to the crowd, get your bonds here, 6% bond over here. Now, if the market rate of interest is 8%, that's what's available out in the rest of the market, like the booths that are, beside us and across the aisle there. These crowds that are walking by, do they want our bond? Our bond is going to earn them 6% interest on their investment. And the market, everybody else out there, the market rate's 8%. Meaning if they bought something else out in the market, they would earn 8% interest. So, do the crowds, do they want our bond? No, our bond doesn't look very attractive. So, how do you sell or issue something that isn't attractive? You discount it. Our bond will be issued at a discount, meaning it's issued for less than the $1,000 face value. The stated rate of 6% is less than the market rate of 8%. So the bond will be issued at a discount. The proceeds will be less than the face value. Now, let's change our example. Let's say we still have our $1,000 face value, 6% stated rate bond. But now, the market rate is 5%. So we're still over here going, get your bonds here. We got a 6% bond over here. How will the crowds react? Will they want our bond? Yeah, they will, right? Our bond is very attractive. Our bond will earn them 6% interest instead of the 5% available elsewhere in the market. So who wants our bonds at this carnival? Everybody wants our bonds. So when our stated rate is better than the market rate, we will be able to issue the bond at a premium, more than the face value. The stated rate of 6% is more than the market rate of 5%. So the bond will be issued at a premium. The proceeds will be more than face value. Now, what if the stated rate and the market rate are the same? Let's say they're both 6% in my example. Then the bond is issued for exactly the same as the face value. Is what we've covered so far giving you a better understanding of long-term liabilities? I really hope that this video has helped. If you want to learn more about bonds and how to calculate the issue price, discounts, and premiums, then click the link below or go to glime.com and look for our free basic accounting course in the CPA free resources section. In the course, you'll find great information on other topics, such as all the details on how to prepare financial statements and perform financial statement analysis, which can really help you in your financial accounting classes. So click below or go to glime.com to learn more.